Good morning, everyone. Welcome back to the show. I'm your host and its founder, Michael Ravello. I'm a 20-year-old entrepreneur who chose entrepreneurship over the traditional college path, inspired and driven by my goal to retire my mother and to help other middle Americans just like her learn about investing in different asset classes like multifamily real estate, to learn about financial freedom, passive income, and to build long-lasting freedom. Since February of this year, she's been able to step away from her W-2 job and become a full-time entrepreneur with me with Everforward Capital Partners. So very excited about that. And, on my podcast, a lot of the times I talk about the monetary system, gold, silver, how can we save at least our dollar value? What does all this finance stuff mean that we haven't been taught in school? My mother of the Gen X generation, those that are listening, if you are Gen X, we as a collective, we don't know how this monetary system works. How does the dollar work? How do central banks work? And a lot of us just go, oh, it's just another news headline. But little do we know, it actually affects us at the core level. I'm not an expert on it, but this is why we bring experts on the show to discuss topics like this. And today, our featured guest is perfect on speaking on this. Paul Musson, it is a pleasure to have you on the show, my friend. How are you?
Well, I'm doing great, Michael. And I'm really happy to be here.
Absolutely. And you're based out in Toronto, correct?
Yeah, Mississauga. It's a suburb of Toronto. Yeah.
Awesome. So, Paul, we've been chatting a lot over email, and we've had a little bit of a dialogue before the episode started. But Paul, what got you to this point today? What industry are you in right now, and what's your forte? Who is Paul, essentially? So the floor is yours, my friend.
Okay. I'll try and keep it brief. So I was a professional investor for most of my career, mutual funds, equities. So investing in global stocks. And I absolutely loved my job. It was an amazing job, great company, great team. I loved every aspect of it, doing the research, doing the communication, the marketing, you name it. And in part, it was because I thought I had an important role to play. For many years, for many years and still, I've always had this attitude where I didn't want anything that I didn't earn. I didn't want to take more from the system that I had put in. And this was when I was very naive with respect to how the monetary system worked and all that kind of stuff. It was just sort of a moral issue, I guess, with me. And I didn't want to think that I owed anybody else anything, even if I didn't know them. And so when I was investing, it was perfect because a free market capitalist system, the way it is supposed to work, increasingly it doesn't. That's why people are angry. But the way it's supposed to work is that you are only supposed to benefit to the extent that somebody else benefits from your actions. You create capital and you exchange it with someone else for the capital that they created. You make a bike, I make a suit, we both created capital, we exchange it with each other, and it didn't come at anybody else's expense. Nobody was harmed by that. There was no bike or suit in the economy. We both created it and then exchanged it with each other. We use the medium of exchange called money, which we can talk about later. So as an investor, I was taking my clients' capital that they had created through their careers and saved. I would take that capital, allocate it to who I thought were the best run businesses around the world, who would take that capital, put it to productive use, create more capital, increase their profit, hire more people, pay them more, increase the dividend, the share price goes up, our fund goes up, our client makes money, I make money, the company makes money. Nobody's suffering in this. So that's why it's supposed to work. And to a large degree, it still does. But increasingly, particularly starting in 2001, 2002, with Greenspan and then Ben Bernanke, the Fed chairs, they started to sacrifice the real economy on the altar of higher asset prices. And we can talk later about exactly how they were doing that and why, with good intentions, by the way. They're not evil people. And at first, as I said, I was fairly naive about what the hell was going on. But I was getting frustrated as I saw them sort of foment this housing bubble in the mid-2000s, in 2005, and it peaked in 2006, I think it was, in America. They were establishing the conditions and encouraging this sort of behavior because it was creating what's called a wealth effect. I call it a fake wealth effect in housing. People extracting hundreds of billions of dollars and spending. And then I was even more upset at the response to the financial crisis where they bailed out Wall Street. And then the successive rounds of quantitative easing, printing trillions of dollars or creating
Right.
trillions of dollars. And so as I saw this going on, I became increasingly frustrated, started talking about it with my clients, started studying economics, economic theory, monetary theory. That's all I've been reading for the last 17 years or so. And communication became my great passion. And a lot, because and my goal is always intellectual honesty. It's all about empowering people with truth and understanding rather than just trying to impress them with how smart I was or what a great investor I was, all this garbage. And so over the years, people were saying, Paul, you should really write a book about this because you're the only one who speaks to us in English about this. You don't use the fancy financial jargon and blah, blah,
Yep.
blah. And so I finally decided to do it. Took me a long time to write it because I was still working. And now I have a free blog, weekly blog that talked about the similar stuff. And I started my own firm called Paddington Capital Management, which is investment consulting. And so, but my main job now is communication. And so this is how I ended up. And I wrote a book. Yeah, it's called Capital Offense: Why Some Benefit at Your Expense. And and so that's what got me here today.
It's an interesting story. And, thank you for sharing that. And you make a lot of good points on there. How does this all work? How does this affect other people? And how can we build a system that doesn't harm any parties? I mean, there's just so much jargon going around on the news and all the financial markets that sometimes we go, is this English? Like, can I understand this? And, for young entrepreneurs or those that are just starting out or those that want to get into finance and then just learning all these terms, it's kind of like this massive migraine of just trying to put them all together. It's like, how do I decipher this? How do I translate this so that I can understand it and so can my clients? And you saw that and you're like, well, let me just put that into plain English, and you wrote a book about it. And that's the huge part of value there is that, you saw it firsthand and you know how the system's supposed to work. You know the structure. It's like, well, how can I teach people this without sounding like, this front news of, the Wall Street Journal in the financial section where it's not like full all these terms and everything. So I kind of want to travel back into time a little bit.
Yep.
So for me, of course, being 20, I was born in 2005. I'm not very familiar with, the early 2000s and the 2008 market crash. So between the years of 2000 and 2008, what happened there from your perspective that changed the course of the financial markets entirely of what it is today? Like, for example, I forget what year Nixon took the gold standard off the dollar. I think it was 71. I think I could be wrong. And that alone changed the course of the trajectory of the dollar for years and years and years. I mean, Peter Schiff has talked about it, like it's decreased by 99% in value, and there's a potential for it to collapse. And, for us, it's like, well, what does that mean? Well, this phone, let's just say, for example, that would have cost, let's say $200 back then, and now costs $900 because of inflation and mass production of money. Yeah. Anyways, to cut back to the chase, what happened in the early 2000s and how has that shaped, today's economy and today's finances for middle Americans like me or those like you that are just trying to understand what is our economy doing right now and how has the past affected it?
Yeah. Okay. Yeah. Great question. So, yeah, you were right. It was 1971. When Nixon took the U.S. off the gold standard, August 15th, to be precise. And it was a real game changer, which we can talk about as well. But so what happened in early 2000s? You have to go back to the late 1990s when you had the dot-com bubble. So you had that crazy technology stock market, irrational exuberance, as Greenspan first called it, but then he stopped calling it that because he was trying to, in my opinion, rationalize higher stock prices and said, well, this is just productivity growth and it's warranted. You can never know when the stock market's in a bubble, so we shouldn't try to do anything about it because we can't know what the true value of stocks are, so we shouldn't do anything about it. But they only say that when the stock markets are in a bubble. When it tanks, they decide to do something about it. All of a sudden, they can value stocks. Anyways, it's another story. So the tech bubble, was creating what's called a wealth effect. Now, wealth effect is you see your stock portfolio going higher and you feel wealthier because you are wealthier. So you might go out and spend more of your money. You might use your stocks as collateral for loans and go shopping and buy an F-150. You might buy a new flat screen TV, whatever. And that's good for the economy, they think. It increases GDP. GDP is just a measure of all final spending. If GDP is going high, it doesn't necessarily mean it's good. You have to know why it's going higher. Is it because people are producing more stuff and they got the wherewithal to go buy other things? Or are they borrowing money, taking on more credit cards? And that's why GDP is going up, right?
It's the reason behind it, the driving factor.
Exactly.
That's the most important thing.
Exactly. So anyway, so wealth effect. And when you think about it, as I said earlier, when I was putting my clients' capital to productive use with companies, and if you got all companies in the stock market, they're all creating more and more capital and they're more and more profit, that pushes their share price higher. And so a rising stock market is symptomatic of lots of good stuff going on in the economy. At least that's the way it used to be. Then you had the dot-com bust, bear market, which started, I think it peaked in March 10th of 2000. And that created a negative wealth effect. People saw their portfolios going down in value. They started spending less. And so then around 2001, I guess it was, or 2002, commentators like Paul Krugman from the New York Times and Paul McCulley, who was with PIMCO, the big bond investor, they recommended that Alan Greenspan should start a new wealth effect. But instead of in stocks, he should create one in the housing market. So lower interest rates to very low levels make mortgages more affordable, not houses. And that will drive housing prices higher. More people own homes than stocks, so more people will benefit from a wealth effect, and it will extract equity from their homes and spend it, and that will be good for GDP. So by 2003, the Fed took the Fed funds rate down to 1%, despite the fact that the economy was still growing. You guys had a very mild recession in 2001. It was only 1 quarter of economic contraction, very mild. So interest rates were taken down to what would be considered emergency levels, not because the U.S. was in an emergency, but because Greenspan was trying to inflate the housing market to create a wealth effect so people would spend more money. And people responded accordingly. That's exactly what they did. And
almost like a smoke screen.
Yeah, no, exactly. And then everybody started turning blind eye to, subprime and all this kind of stuff. And there was those ninja loans, right? No income, no job, no assets. You still get a mortgage. You fog a mirror and you're in. And then they blew the whole thing up. And you had that great financial crisis in 2008 and 2009. And rather than say to themselves, well, maybe we shouldn't have done that. Maybe we shouldn't have interfered with markets, with the price discovery mechanism within capital markets. We shouldn't interfere with people making their own risk return decisions with their own skin in the game, their own capital. You should not be deciding. Let them decide. No, then they doubled and tripled down with quantitative easing, printed trillions of dollars and bought 10-year treasuries, bought mortgage-backed securities. And then they did QE2, and then they did QE3. To me, that was the beginning of the end. They got themselves on a treadmill. There was no getting off of it without asset prices plummeting. And so I like to say that what they did was, in my opinion, they sacrificed the real economy on the altar of higher asset prices. And they did so not because they're evil, not because they're deliberately trying to enrich the top 1%. I believe that they thought that by enriching the top 1%, the top 10%, somehow over time the benefits would trickle down to everybody else. Well, they haven't, and theory would tell you that they won't. And the distortion of interest rates to very low levels, the printing of trillions of dollars, is extremely harmful to the economy and creates absurd amounts of wealth inequality. And we can go through the mechanism of how that happens if you like. But that's essentially what happened from early 2000 up to the financial crisis.
Absolutely. And, there's a couple of things that you mentioned there. When the dot-com bubble popped, essentially, when people's portfolios just started to go down like a lead brick underwater, they started to spend less. There's this saying out there, asset rich, cash poor. I mean,
Yeah.
you could have a bunch of assets, but what does your cash flow look like? What does your ROI, your return on investment look like?
Yeah.
That'll tell you exactly what it is. And not only that, I guess what the Fed was trying to do was try to course correct, but at the same time they were applying the wrong pressure, because I think there's good pressure and there's bad pressure. I think they were applying bad pressure to a sense where they're trying to course correct, but all of a sudden they went to this death spiral of the treadmill that you mentioned. That they think like, all right, let's just fix this and it'll start to trickle down and everything will start to even out. But it sounds like we're still on that treadmill today. Like, for example, when my grandparents first bought their house in the United States, it was like $60,000 or $65,000. It sold for $500,000, and it was like worth like 600,000. And it was like, holy, like just that amount of time. I think it was like 50 years, but it just goes to show you, that's what happens over time with appreciation, the overproduction of the dollar, because they were trying to bail out Wall Street from this crash. And it's just all these little variables that add up, that eventually it's like this little pebble, add more, eventually it's going to turn into a mound. And that's what I'm seeing. Correct me if I'm wrong, but
that's exactly right. These little things, we'll just do this, we'll just do that. Then there are these, unexpected consequences or knock-on effects. Okay, now we have to do this to manage that. Oh, there's more now we go to, and it just spirals out of control. And just to give you a stat here, just to show you how crazy things are. So in America, the percentage of equities and mutual funds that are owned by the top 10% of Americans is 87%. So 87% of all equities and mutual funds are owned by the top 10% of income earners in America. The bottom 50% of Americans own 1%.
Wow.
Now it's extremely stark. Now, there should be wealth disparity based on your contributions to society. So if you and I both own a bike store and you decide you want to make 10 bikes a week, I decide I only want to make 1 bike a week because I'd rather go bird watching and watch some TV and whatever. It's a personal decision. Then by all rights, your wealth should be 10 times what my wealth is. There's nothing
immoral. I'm producing more.
You're producing more, and it hasn't come at my expense, right? So for a lot of very successful people, their success has not made other people poor until central banks entered the equation and started distorting interest rates and printing money to the tune of trillions of dollars. That does harm other people. Then people are able to make money at the expense of others in society. And so people, particularly younger people, they're getting very frustrated because they are just as well educated, if not better educated than their parents, willing to work just as hard, but can't even dream of affording the same sort of lifestyle that their parents had, can't dream of affording the same sort of house that their parents had. And they said, why is that? Who's benefiting at my expense? They don't know exactly how it works, but they're angry and they need someone to blame. And then it becomes very easy to become political, for Republicans to blame Democrats, Democrats blame Republicans. And then you have this massive divide in your country where people can't even talk to each other now. And these issues transcend politics, right? It doesn't matter who's in power. It's been the central bank. That's been the main issue. Now, the most recent presidential approval ratings, as you might expect, they're right down party lines. So 85% of Republicans approve of Trump, only 5% of Democrats do. With Biden, it was the opposite. 85% of Democrats approved, 6% of Republicans. But back in the 1950s, when Eisenhower was president, Republican, 49% of Democrats approved of what he was doing. When Kennedy was president, a Democrat, 49% of Republicans approved of what he was doing. So there were differences, as there should be, right? We
Absolutely.
have differences, and we can talk about it and discuss it, and then we can change our vote next election or whatever. Now the divide is such that people can't even talk to each other. No matter who your leader is, you're going to vote for them because that's how you identify yourself with this party now or whatever, and
Exactly.
it's so sad. And really good people. We have a place in South Palm Beach in Florida, a condo. We bought it during the great financial crisis, by the way. And we've got a lot of friends down there, both Republican and Democrat, all beautiful people, all super smart as well, but can't really talk to each other. You know?
Yep. And what the sad part is, Paul, whether it's finances or politics, I have friends that are, Democrat, Republican, Independent. I mean, the whole board spectrum. I
Yeah.
always come to the table with agree to disagree. I'm willing to have, a conversation about it. It's like,
Yep.
I'm not going to hate you because you voted for so-and-so.
Yep.
That's just not me. I'm willing to talk about it, discuss it. Like, for example, finances. People might have different perspectives of who to blame, who to point the finger to. Me might be different, but like, hey, this is my reasoning. This is my thought process. What is yours? Which really ties back into the power of sales, but I won't dive into that. And it's like, just why can't we just come to a common ground or,
Yeah.
consensus to go, well, listen, here's the issue at hand. I understand we're divided, but, on views, but how can we build together? And, just that creates unity in itself.
Yeah.
My generation, especially, I mean, they're haywire. I mean, my generation is just off the charts, with just between figuring out, well, how am I going to buy a house? How am I going to afford a nice car? The nuclear family is so
Yeah.
quote, like, the house, the car, the white picket fence. For them, that's a pipe dream for them to go, am I going to be a renter? I mean, when you look at the statistics for real estate, I'm going to dive into real estate in a second. I mean, most of the United States population is moving towards a renter's nation instead of an owner's nation. United States has been known as an owner's nation. Everybody was able to afford a house, the car, able to get groceries. I mean, bread was what, 50 cents at the grocery store. And now it's like $5 a loaf or something like that.
Yeah. That's a lot of bread. Yeah.
Yeah, exactly.
Yeah.
And, it's just all these things that they think about, but they don't understand it. They don't understand the root cause. They're just like, all right, here's the issue. Who do I blame it to?
Yeah.
Unlike us, you and I, it's like, how do we, what's the root cause? How do we go about this? And the reason why I chose real estate, specifically real estate investing, is I've always heard, it's good for taxes. It's great for hedge against inflation.
Yeah.
It helps create cash flow. It's a hard asset. It's a tangible asset. And you and I talked about real estate a little bit before our call, but, with the, I guess, volatility of confusion between the stock market and the Fed share, how important is it to have hard assets right now, especially today, with like, a real estate investment, whether it's a condo, a duplex, triplex, or a massive 100-unit multifamily? How important is, I guess, a hard asset to have now to at least have some sort of a stability for who knows what's going to come down the pike?
Yeah, I think it's very important for it to be part of a balanced portfolio in things that you really understand. And there are other hard assets as well, like gold or other commodities.
Mm-hmm.
People even look at exotic cars and art. I mean, that's out of my league. But yeah, no, real estate, because I mean, I've got real estate, and central banks haven't yet figured out how to print houses. And so the value of your house will be dependent on the fundamentals, demand and supply, but building, not printing. And so I think real estate can protect you longer term, but as you know, the price you're paying matters a lot.
100%. Yes.
And so if you're overpaying, and it's the same thing with investing in high quality stocks, which I used to do. You could have a super high quality business, great return on capital, generating lots of free cash flow, strong balance sheet, steady growth, a competitive advantage that you thought was sustainable because it had a great corporate culture, everything, tick all the boxes. But if the stock was too expensive, it would be a lousy stock. Great business, lousy stock. So price matters, and I'm sure you know more than most, right? So yeah, absolutely. You get a right price, definitely real estate should be part of your portfolio.
Yep. And, with everything that's going around, I just recently was starting to learn about gold, silver, oil, and all of these, precious metals or minerals.
Yeah.
And I was trying to piece together, well, I have all this cash flow coming in from multifamily. Well, how do I preserve it? And I was talking to Brian London and other big gold bugs like Russell Gray. And they said, when you get this kind of cash flow, investing in gold and silver, because that'll preserve the dollar, that'll preserve your cash flow. So it's not eroding throughout the market cycles. And I was like, interesting. So you're right. It is important to have a balanced portfolio to the point where, what were you going to say?
Yeah, I would just say, but the price of gold also matters.
Yeah.
Right?
What is it, like way over 5,000 now? It's like,
it got to 5,500, I think. It's 4,500 now.
Okay.
And so the way I think, I'll just say what I think about, like I'm invested in gold bullion. And the way I think about it is not so much as an investment as more of a hedge. It's my central bank lunacy hedge. And so we can talk about it if you want, but a lot of people believe, and I'm one of them, who thinks that policymakers will attempt to get out of this debt quagmire through something called financial repression. So what it means, you're going to be repressed financially, all of us. This is not a good thing. They just throw the term out there like as part of their toolkit. Oh, well, financial repression. No, this is terrible. It's immoral. So financial repression is the government is spending way too much, way more than they take in tax revenue. And just as a reminder, the government does not create any capital. All the capital that the government spends or hands out, it first has to obtain from the private sector in one of three ways: taxation, borrowing, or printing money. And we can talk after how the printing money actually takes your capital from you. And so when they keep borrowing, people think, well, they're not going to be able to pay me back. So I'm going to require a higher interest rate. Like they'll be able to pay you back, but not through the tax revenue that they're collecting. They're going to have to print money. So you've been talking about this, throughout this podcast, that they're debasing the currency. So if I lend them $10,000, yeah, they'll pay me $10,000 back in the future, but those $10,000 will be worth half as much as they were when I lent them the money. So
It's true.
So they're taking half of my capital from me. So guess what? I want 25% interest rate, whatever. So what they will do is, as they're printing money, they will cap interest rate. There'll be something called yield curve control, and they will print as much money as they need to buy the amount of government bonds that will keep interest rates at a certain level. And a massive inflation, the price discovery mechanism of capital markets completely distorted, really bad for the economy. And so that's why a lot of people are buying gold, and because it will be a hedge against all of that. So my gold might go from $4,500 an ounce to $10,000 an ounce, let's say. But it's not that the gold went up in value. It's that the dollar went down in value. So my $4,500 ounce of gold, when it gets to 10,000, might still buy the same amount of stuff. It still might only buy 4 bikes. But if I held US dollar, it would only buy a tenth of a bike or something like that.
If you're lucky. Yeah.
If I'm lucky, yeah.
That makes sense. And I would love to dive into a little bit, how you're saying printing money actually takes away your capital. So if I understand this correctly, I want to dive into this a little bit, where the more they print money, the more capital's being taken away from you because, let's say you have a $1 amount of value, but if they print more, it's going to degrade, and therefore you're technically losing capital. Even though you still have that $1 bill, the value is being taken away from it, if I understand that correctly. But I would love to dive into that. And is this going to get worse? Is this just going to stagnate, or what are we seeing now?
Okay, so I'll give you an example or analogy, if you will. And yes, it will get worse unless we change it, which is why I've written a book. So capital and money are not the same thing. Both very important. Capital is anything that you may produce, a good or a service. Your podcast, you're creating capital that your listeners consume. So let's say you create 10 bikes of capital. You sell those bikes for $1,000 each. You've got $10,000. You throw that in your bank account. That $10,000, that's called the medium of exchange, the money. It's temporarily storing the capital that you created. The 10 bikes that you created is temporarily being stored in that $10,000 of money. So when let's say you're going to go on a nice vacation at the end of the year, you spend your $10,000 on that. What gave you the wherewithal to go on that vacation was the fact that you created 10 bikes of capital, right? So you're not going on a vacation at somebody else's expense. You created capital and you're exchanging it for the vacation you're going to go on, that capital, and you're using the money to make the exchange happen. So you got 10 bikes stored up in your $10,000 in your bank account. But before you get a chance to go on your vacation, the central bank doubles the money supply. Now, when they increase the money supply, they do not create any capital. They create money that has no capital stored up in it. They just create it out of thin air. They push a few buttons. But that new money obtains capital as soon as it comes into the economy. So as soon as that doubling of the money supply enters the economy, it takes 5 of your 10 bikes from your $10,000 and puts it into the newly created money. So now your bank statement says that you still have $10,000, but instead of storing 10 bikes of capital, it's only storing 5 bikes of capital. So your $10,000 will now only buy half as much as it would have done before the central bank doubled the money supply. And so what that is inflation. They double the money supply. The prices is that everything doubles. Your vacation went from $10,000 up to $20,000. So your $10,000 will only buy half of a vacation because your $10,000 only has half as many bikes as it did before they doubled the money supply. That's how they take your capital from you. That's why my book is called Capital Offense, Why Some Benefit at Your Expense, because you didn't sign up for that. You know, you can vote for the party and decide, okay, how comfortable are we with the amount that we're being taxed? Probably not very comfortable, but, you know, it's a lesser of two evils.
Right.
But we can vote for that, and we can voice our opinions and demand lower taxes or fairer taxation or whatever. But we don't vote for the central bank. The central bank is appointed by Congress. And so we don't have any say in terms of how quickly they increase the money supply and extract our capital from us and create inflation and increase the cost of living. And it hurts lower income people far more than it does higher income people.
Absolutely. That's where they're getting burned the most is, you know, not your top, but it's the ones that are producing the capital. It's, you know, your baker, your candlestick maker, your butcher, everything else. Those are the ones that are getting hit the most. I could go down that rabbit hole for hours, but I'm not going to. But Paul, I guess to wrap up our episode, with so much uncertainty that's out there economically for families, entrepreneurs, you know, those that are making lesser of income, those aren't in the 1%. What do you think, besides reading your book, because we're going to dive into that in a second, what is the best course of action someone can take right now to at least be more financially educated, more financially aware, to start planning in case of the economy decides to go into another death spiral, or if something drastically were to change with the central bank or politically? So how can they start preparing now? What can they look for, and basically how to prep?
Yeah, well, as you said, it sounds arrogant, but yeah, I would say start with my book. And, you know, I've written it very easy to understand terms, step by step, you know, so I don't intimidate people into silence or into just giving up. And because I think the average person is very smart, but they don't speak the language of finance. That's why they cannot contribute. And I liken it to somebody asking you a question in Greek. You can't answer it. It's not because you're not smart. You just don't speak Greek. So I'm trying to help people understand the language. The first three of the first 4 chapters in my book are explaining what money is, which is more complex than you think. But once you understand it, so many other pieces fall into place very quickly. And then I've got references in my book to other authors who talk about this stuff, and so people can slowly educate themselves and not be intimidated by the subject. Stop believing in the something for nothing fairy tale. This is what we've been fed for years by policymakers, that governments can do all this spending and it comes at no cost to society. Social Security, your Social Security in America, on the current path, will be insolvent, I think it's in 2034. So you got 8 years before some change has to happen, either in terms of contributions or benefits or the age where people can start collecting it. And on the current path, it'll be insolvent and there'll be a 25% haircut to benefits, which is totally unacceptable, of course. But no politician wants to deal with it because it's political suicide, because both sides of the aisle have convinced us all that it's affordable, that we deserve it, blah, blah, blah. And it's not that anybody's bad people or that you don't want people to have more stuff. It comes at somebody else's expense and it has to be funded somehow.
Right. It's like robbing from Peter to give to Paul.
Oh, exactly. So, and I find that, when you explain things to people, when you understand incentives and stress and pressure that other people are under, when you really understand what's going on, with that also comes greater empathy. If as long as you feel that you're not getting screwed, and I think that's where people should start, and don't give up. I hear a lot of young people use terms like YOLO or FOMO and stuff like that. And
Right.
the average age of the first time home buyer in America now is 40 years old. Because not because they want to wait till they're 40, they can't afford it.
Right.
And in Canada, it's way worse. In Australia, it's way worse. And so people are saying, look, it's going to take me 20 years to save up for a down payment. And even then, I probably won't qualify for a mortgage. So screw it. I'm just going to spend my money, travel, have a great time, post things on social media. I understand why they're doing that. But I have a feeling, I believe that housing is going to become more affordable. And so I would really, hope people don't give up. Keep saving, keep carefully investing in diversified portfolios of quality stuff that you really understand. Don't believe in the too good to be true investment. Just recently, a good friend of mine was talking about a guaranteed investment return that was 25% per year. Now, the first thing you should ask yourself is, how come everybody else is so stupid that they haven't recognized this opportunity? And
Yep.
if somebody's got a guaranteed 25% return, they're not going to share it with you. They're going to keep it for themselves. But it's so alluring because life is so hard that we all want to believe these investment returns are possible and it's going to make our life a little bit easier. And these people prey on that, which is really disgusting. And so just keep it real, keep moving forward, and keep educating yourself about what's going on. And, last thing I would say about that is that there's a saying, this goes back hundreds of years, that the people always get the government that they deserve, i.e., you voted for them, so shut up, stop complaining. Well, no, people only get the government they deserve if they actually understand what's going on and can vote and demand accordingly. And
Don't vote blindly.
yeah, and I don't believe that, with respect to the monetary system anyways, and even how an economy truly functions, most people don't really understand it, and so cannot demand that the government stop doing what they're doing, which is very destructive. And so that's, again, part of the idea behind the book: empower all these very smart people who work hard, their own skin in the game, and give them a voice so they can contribute to positive change, because that's the only way it's going to change. It will not change from the top down because everybody below is expecting all the free stuff, so they'll just vote them out of office, right? So it's got to come from like a grassroots movement from below and say, hey, you start doing the right thing. And then the policymaker says, well, this is how I stay in power, by doing the right thing. Who'd have thought? And they'll do it because they're not bad people.
It's true.
You know?
Absolutely. And you said it perfectly. And that's a perfect way to wrap up our episode. One last question, Paul. Where can people find your book to purchase it or either read it online?
Yeah, thank you, Michael. So it's you can get it on Amazon. You can get it Barnes and Noble. It's just online. And it's also on Audible. So if you prefer to listen to the book, and I narrated it. Took me a while, by the way. But and then I have a free blog on my website. It's called Political Economy. So it's my first name, Paul, itical, ITICAL.com, economy.com. And so you can sign up. It's free, and there's no strings attached, no credit card needed. Just put your email in there. You got a weekly post from me talking about what's going on in the economy, what's going on with the new Fed appointee, Kevin Warsh, or all that kind of stuff. And again, I do it in easy to understand terms, have some fun with it. And all my interviews are up there and stuff, so they could check it out.
Awesome. Thank you so much for that. And ladies and gentlemen, you've heard me preach about this all the time. Self-education is the key to whatever you need to do to start moving forward. And Paul, you've touched upon that a lot. Everybody, I do recommend you go to his website as well. Please get his book too, to start educating yourself and learn about how the monetary system works along with the central bank. What does housing mean for us? Because I believe the more we start to learn and educate ourselves, the better decisions that we're going to make, instead of just blindly voting and blindly making decisions that could inadvertently detract from the future we're trying to build. And I do see the pendulum swinging into our benefit to, more affordable housing. The economy is going to breathe again instead of it being choked, but I don't know when. But there's always hope, and I'm definitely not going to give up. But ladies and gentlemen, if you want to learn more about Paul, please check the description below of this episode. Please go follow him. Please go check out his blog, and please go get his book. Ladies and gentlemen, you've been listening to the Ever Forward Mindset podcast. I'm your host, Michael Rebello. Build yourself better and bigger every day. Live better, live bigger. Always move ever forward. Paul, thank you so much for joining today and sharing your amazing wisdom. I've learned so much. I know the audience is going to learn a ton more. Thank you so much again. And thank you for being on.
Well, thank you, Michael. I really enjoyed it.
Awesome. Take care, my friend.
Take care. Bye-bye.